Hello, my name is Steve Bigelow with the Candlestick Forum. The market is very easy to assess over the last few days based upon the candlestick signals and the T-line. We saw last week where the Dow came up and did a shooting star failure at the 50-day moving average. The next day, they gapped it down and did a bearish kicker signal. The bearish kicker signal alone is a strong reversal signal, the strongest of the candlestick signals, individual candlestick signals, and they closed it below the T-line. Now you can use the T-line rule, which says as long as they cannot close it back up above the T-line, you're still in a downtrend. Now this helps eliminate emotional trading. Notice that the next day they traded it up. If you were short positions, that might have made you a little bit nervous. However, the fact that you knew that it hadn't yet closed above the T-line allows you to kind of hang in there and wait to confirm what the candlestick sell signal has already indicated and the fact that you're trading below the T-line. Same scenario occurred today. They opened the market stronger, but you still had to wait to see whether they were going to continue to take it down because you had two pieces of evidence. One, a strong sell signal, the kicker signal, and two, the fact that they hadn't closed it above the T-line. This keeps your emotions out of your trading decisions. So this, using both the Dow and the NASDAQ, notice the alert on the NASDAQ last week. Bullish candle, and they gapped it down and did a doji at the low of the previous day. Logic says if the bulls are in control, the bears shouldn't be able to gap it down below the previous day's trading. Then notice what happened after that. They opened it lower, giving you a bearish best friend. You just stay short until you see a candlestick reversal signal. This is called the blue ice failure, where they failed here at this level. The next levels down may be the 200-day moving average. So this allows you to keep your emotions out of your trading. Notice what happened up here in Apple. First of all, it was a good short until they gapped it down and it was time to cover the short. Then they showed that they failed at the T-line. The failure was a bullish candle and a gap down below the previous day's open. That's an immediate indication the bears are back in control, plus the fact they couldn't get it up above the T-line told you your high probabilities were that you were heading down. Notice also, could have been a little bit testy if you were short, where they were trading up during the day, but the one qualifying factor would be that as long as you're below the T-line and it closes below the T-line, you can stay short. Same scenario over here in NVIDIA. A double bullish flutter kicker signal. Bullish candle, they gapped it down below the previous day's open. They gapped it down again, did a doji, they gapped it down again. Remember the doji rule. They're going to move the price in the direction of how they open after a doji. Even though it traded up today, still no signs of bullish strength. You just stay short. So using candlestick signals and gaps produce very high probability trade direction as well as very powerful trades. We were shorted NET because of the hanging man gap down. Notice where the gap down occurred after the hanging man signal, below the T-line. Notice when they gapped it down again. This tells you there's lots of force to the downside, which if you're observing what the market trend is doing, you want to find the ones that had the biggest, most powerful price moves during that trend. Now remember, a candlestick signal and the gap is a very strong trading strategy, whether it's bullish or bearish. We were recommending Sting last week because there's your best friend, gap up, and notice what it did today. The market was down huge. The stock was still trading positive because this is illustrating there's lots of strength coming into that stock as well as that sector. So if we can add 2 plus 2, we recommended ATHM the other day. Look at your series of dojis. Stochastic's turning back up. They came up through the 50 and now positive trading the next day. Notice what they use. They use the 50 to see if it's going to act as support, which they did. So now you have a very strong China-related stocks trading positive, which also helps you take profits at the appropriate time. Notice that Bidu could never get back up above the 50. There was your evening star gap down, good short, but today it did a bullish harami, almost in the oversold area. It's not confirmed, but if we know the China-related stocks are getting bought, and this did a bullish harami, the probability factors say, let's go ahead and start taking our profits on the short position and go someplace else where we know there's not a lot of buying coming in. So tonight, you might want to join us. We're going to be doing a quick session on how to use spreads appropriately, which is going to lead up to a free option training session on Saturday. But our Thursday night sessions are free for everybody to come and join. And we're going to just go through the benefits of how spreads work much more effectively than buying calls or puts outright. So right now, obviously the bears are in control. Will they bounce it? Could be, but we have one criteria to work with. As long as we're below the T line, assume that the downtrend is in progress. The 200 is down here somewhere. That makes this a very obvious bearish J-hook pattern that could be heading lower. When you have the ability to analyze what's going on as far as signals in the market trends, you just allows yourself to put yourself in positions where they're going to have much more strength, knowing that you're going with the flow of the market. That'll be it. Join us tonight. Free sessions. We'll see you in the chat rooms.